Welcome to This Explainer. If you've ever stared at your portfolio statement and wondered how all those numbers are really put together, you are in the exact right place. We're going to lift the hood and break down the entire architecture of a mutual fund so you know exactly how your money is valued, protected, and ultimately taxed behind the scenes.
Today, we're mapping out the complete journey of your investment across 5 crucial areas: calculating your NAV, why marking to market matters, the total expense ratio, dividends and exit loads, and finally, mutual fund taxation. Let's get right into it.
Section 1. Calculating your fund's NAV. Let's take a look at the actual dashboard of your investment vehicle, the net asset value. You check your portfolio, right? And you see that single price tag per unit. Maybe it says 50 rupees, maybe 150, but how exactly is that number calculated behind the scenes every single day? It's not just some random market ticker, it's a highly specific mathematical formula.
Think of the NAV as the true current worth of a single unit. It's actually a pretty straightforward equation. The fund takes the total value of all its assets, subtracts any liabilities it owes, and then takes that remaining pool of money, the net assets, and simply divides it by the total number of outstanding investor units.
Let's ground this with a real example. Imagine investors buy 20 crore units of a brand new mutual fund at 10 rupees each. So the scheme has mobilized a starting pool of 200 crore rupees. The fund managers then take this capital and deploy it directly into the market.
Let's see how the math actually plays out. Say 140 crore was invested in equities and grew by 10%, becoming 154 crore. Meanwhile, the 60 crore parked in bank deposits netted out to 64 crore after income and expenses. This brings our total scheme assets to 218 crore. Subtract the 1 crore in unpaid liabilities, and we're left with 217 crore in net assets. Divide that by our original 20 crore units, and boom, your new NAV is exactly 10 rupees and 85 paise per unit.
Section 2, Marking to Market matters. Because for that NAV calculation we just did to actually be fair, funds have to ensure those underlying asset prices are completely accurate and up to date.
Here's a critical reality check. If a fund bought a stock at 15 rupees and stubbornly kept valuing it at that original price, even after the stock skyrocketed to 50, your NAV would be pure fiction. Anyone buying or selling units needs a price that reflects reality today. This is exactly why all assets must be marked to market, meaning they're valued at their real-time, current market price.
To guarantee this accuracy, the regulator, CB, laid down fair valuation principles. The golden rule here: valuations absolutely must reflect the realizable value of the securities. In plain English, what could this asset actually be sold for right this second? No artificially inflated numbers allowed. If a stock isn't actively trading, the asset management company has very strict procedures to estimate a fair value so your NAV is never manipulated.
Section 3. The total expense ratio. Valuing the fund and executing trades takes serious operational effort, which brings us to the fuel keeping the whole vehicle running. Look, running a mutual fund isn't a charity. The asset management company, or AMC, incurs real recurring expenses. They're paying fund managers, covering marketing costs, shelling out broker commissions, and paying auditor fees to keep your assets safe. All these operational costs are bundled up into one total expense ratio and charged directly to the scheme itself.
Fortunately for us, SEBI steps in to cap these expenses, protecting your returns. They don't just let AMCs write a blank check. For equity-oriented schemes, the absolute maximum limit starts at 2.25% for the first 500 crores of daily net assets. Notice how, as the fund gets larger and manages more money, the percentage they can charge actually decreases, passing the economies of scale right back to you.
Section 4. Dividends and exit loads. Next up, let's explore how money flows back to you while you hold the asset and what it might cost you if you jump out early.
When you invest, you generally face 2 main choices. You can go with a growth plan where the value simply compounds quietly inside the NAV and you only see the cash when you eventually sell your units. Or you can choose the income distribution cum capital withdrawal plan, which most of us just call the dividend option, where the fund periodically pays out cash directly to your bank account. Now here's a crucial detail that a lot of investors actually miss. A fund cannot legally pay you dividends from unrealized paper gains. Just because the portfolio looks greener today doesn't mean they have actual cash to hand you. They have to actually sell securities and book real, realized profits to generate what are called distributable reserves. Only then can you get paid.
So what about moving your money? Years ago, funds charged an entry load just to get through the door.
which instantly reduced your starting capital. CBI completely banned those, ensuring you always buy in at the exact NAV. However, they can charge exit loads. Think of these as a gentle deterrent against treating mutual funds like day trading accounts. If you leave early, say in year 1, you pay a fee. Hold on longer, and that fee shrinks or disappears entirely to incentivize long-term investing.
Which brings us to Section 5, Mutual Fund Taxation Explained. We've reached the inevitable toll booth at the end of the ride, the tax man.
First off, know that a mutual fund is a pass-through vehicle. The fund itself is generally exempt from income tax. The burden? Yeah, that falls on you. When you sell, profits are classified as either short-term or long-term capital gains. For equity funds, selling before 12 months is short-term. Holding for 12 months or more makes it long-term, which completely changes your tax bracket.
The rules for long-term equity gains changed pretty dramatically a few years back. Pre-2018, long-term capital gains on equity were entirely tax-exempt. When the 2018 union budget made them taxable, they didn't want to unfairly punish investors who had held funds for years, so they introduced a grandfathering clause. This locked in the valuation of your assets as of January 31, 2018, effectively shielding all your gains up to that specific date from the new tax. You're only taxed on the new gains generated after that cutoff.
Furthermore, to support retail investors, the government provides an annual exemption limit. For long-term capital gains arising from equity shares and equity-oriented mutual funds, the first 1.25 lakh rupees of your profit in a single financial year remains entirely tax-exempt. You only pay tax on the long-term equity profits that exceed this specific amount.
So, now that you understand the precise mechanics behind your NAV, the regulatory caps on expense ratios that protect your returns, and the specific tax rules governing your profits, it's time to look closely at your own portfolio. Apply what you've seen today. Ask yourself, what are you really paying in fees? And after taxes and loads, what are you actually keeping? Thanks for joining me on this explainer. And